you'll know they've hit the panic button when they stop quantitative tightening. And that might happen even after the next reduction in the Fed funds rate, because they will keep reducing the Fed funds rate because I think the economy will continue to slow. The Fed is data dependent, and Powell makes that very clear, by the way. And in the spin room today, he told the reporters, "Well, they said, what's going to happen?" He says, "Oh, we'll watch the data. We'll watch the data. We'll keep on top of the data." So they're watching the data, watch, and pretty soon they'll start getting a lot of bad data as we enter the recession, and the labor market will start looking pretty bad, and the Fed will make a big pivot then. They'll lower the Fed funds rate even more, and they'll stop quantitative tightening. That's when they'll stop quantitative tightening. So they will pivot, but it'll all be way too late, because the contraction in the money supply that's going to give us eventually a recession, that all happened back in 2000. It started happening in 2022, a long time ago, about a year and a half ago. You'll know they've hit the panic button when they stop quantitative tightening. And that might happen even after the next reduction in the Fed funds rate, because they will keep reducing the Fed funds rate because I think the economy will continue to slow. It'll continue to show weakness. Like, remember, we had that huge revision in the labor market, where all of a sudden 800,000 jobs were that they told us we had. They said they revised the labor market report, and they said, well, those really didn't exist. So they revised things down tremendously already. He never talked about that, by the way. In principle, being data dependent is a bad thing, and won't guide you because you're not paying attention to changes in the money supply. And you're giving a good illustration of just why it's a bad thing. You're always looking in the rearview mirror with data dependency, because the data that are being generated today are all being caused by changes in the money supply that happened a year ago, year and a half, 2 years ago. The housing market is kind of interesting because, number one, there's a huge backlog. So the housing stocks, builders, I've been bullish on them for a long time because there's such a backlog of housing. If you look at the mortgage rates, they're coming down. And remember, I said yields follow changes in inflation, and changes in inflation follow changes in the money supply. So the money supply change negative, inflation falling, yields falling across the yield curve and in the mortgage market. And we're starting to see an uptick in refinancing in the mortgage market. People are coming in now. It's getting a little bit more active. So I think there'll be strength in the housing market. There'll be certainly more turnover in the housing market. They're going to keep cutting because the economy is going to keep slowing, and you'll keep getting more of these big revisions that the labor market really wasn't as strong as everybody thought it was, and negative weakness, and the more of that the data dependent Fed sees in front of them, they will be inclined to lower the Fed funds rate. And that the Fed funds rate seems to be an obsession with them and with the journalists and with the markets and with everybody else, because the narrative that's followed is all generated in the spin room. You saw it today. You're paying clips, and the journalists eat it up because the journalists always want access to the Fed. And the only way they can get access is if they echo what the Fed tells them. Well, I think the equity markets are very pricey right now, at a very high level by any historical measures and standards. There are various metrics you can measure the valuation, and any of them, they all tell you, no matter what the model is, they tell you the market's pretty pricey right now. So what happens when a recession hits? The top line revenues to companies go down, and their margins start getting squeezed, and their earnings start getting squeezed, and ultimately the PEs come down in the market. So I think the market's pretty vulnerable right now, and I don't think the market's pricing in the risk of war. We have two hot wars going on in Ukraine and Gaza right now. I don't think those are priced in at all. So that's another risk factor that's not in the cards. And I also think China is a big risk, because the golden growth rate that's consistent with hitting the inflation target in China, Hanke's golden growth rate is what? 11% per year for M2. The M2 growth rate is 6.3% in China. China's money supply is growing very slowly. To hit that inflation target they have is 3%. It's not 2%. Their target's 3. The golden growth rate's 11. They're growing at 6.3. Inflation is 0.6%, about 0.5%. There's no inflation in China. So the economy's slumping in China. And what does that mean? China, depending on how you measure it, it's either the first or the second biggest economy in the world, China, and it's very commodity oriented. So the commodity markets, why do you think the oil market's so weak? Why do you think the oil's trading around $70 a barrel? Why do you think oil has come off $11 a barrel in the last 3 months, $5.50 a barrel in the last month? It's because of China. The only thing that counts is what's going on with the money supply. How is the money supply growing relative to the golden growth rate of 11% that's consistent with hitting the inflation target of 3%? And it's growing at about half the rate it should be growing at. Way too slow. China is part of the bullish story on gold, and one reason that I'm bullish on it, because not only the central bank has been buying big time in China, but private investors have been buying big time because they're worried about what's going on in China. There's a huge private demand for gold in China, and in a way, in China, the private buying is a little bit the tail that's wagging the Chinese dog. So you've got publicly the central bank, we know they're buying big time. But one thing people haven't been paying attention to is the private buying and private speculation in China and gold. And it's been very significant. And that's part of the bull run in gold that's been generated. Over the last 3 months, gold, it was over, it hit a new high of 2,600 and change. I think 27 and 20 is the high today. And part of that has been Chinese private, part has been public. But the last 3 months, gold has been up, over, about $275 an ounce. The last month it's been up about $60. That's a lot of that's coming from China. The real estate crash and problems they had in the real estate sector, the press is always writing about that, and the fact that prices of real estate, they're actually going down in China. Well, that scares the pants off of the Chinese. And what do? If you get your your pants scared off, you buy gold to some extent, but I don't think I don't think war is being priced into the markets in general, including gold. I think there's a significant chance for very big escalation in the Middle East. It's happening right now with the attacks on Hezbollah the last 2 days. The Israelis are escalating things, making it much more dangerous in the Middle East. The Israelis are, creating an escalation. An escalation is what? It's dangerous. It should be priced into the market. I don't think it is priced into the market. That's still around the corner. Something that's the general public and market participants haven't realized how dangerous things are particularly in the Middle East. Also, obviously, if the West and NATO decides to escalate by following the recommendations of the United Kingdom, that is to facilitate the firing of longer range missiles by Ukraine into Russian territory, I think that's just a game changer. Putin has said very clearly, by the way, that it's a game changer, and I think that's one reason why Biden hasn't caved in yet to demands by the United Kingdom. The United Kingdom really are the warmongers, and all that started with Boris Johnson when he was the Tory prime minister. He's a little bit of a madman, and he's still in the game. He's still trying to promote this. He was just in Kiev, and now you've got the new Labour government coming in, and the Labour prime minister seems to be just as mad as Boris Johnson. I think the West is panicked right now because Russia is taking Ukraine to the cleaners on the battlefield, and they don't want to get into a situation where things end and they come up with some peace agreement right now, because it's very clear that Russia would keep the 4 territories that it's taken over newly, and they would retain Crimea. I think that's really what's going on with the calculus. What's going on in Ukraine that we don't get in the Western press, but the reality on the ground is that the Russians are cleaning the clock of the Ukrainians. The Ukrainian army is dissipated completely. They don't have any men. I mean, they've killed 600,000 in this war. It's eaten up 600,000 lives, if you can imagine. What a tragedy, and destroyed Ukraine. That's a completely delusional statement. The Russian meat grinder is working at high speed and absolutely grinding up Ukraine. Anyone who's well informed knows very well what's going on. Eastern Ukraine is being taken over, meter by meter by the Russians right now. They're on the move, and the move that the Ukrainians made with the West agreement to go into Russia, it was absolutely an insane political tactical move, because all those troops that were the Ukrainians sent in there, none of them will ever see the light of day in Ukraine again. They'll all go back in coffins. The first order is the direction, and the direction clearly in the Gaza thing is escalation. Israel wants to escalate this thing. And ultimately, if truth be known, they want to drag the U.S. into the whole thing. That's really, and that's exactly the calculation the Ukrainians are making. They'd love to drag the U.S. into the thing. That's what the British seem to want to do too. The paymaster in all of these things, and who's financing at the margin, what's the key financer? It's the U.S. The U.S. is financing both of them at the margin. If the U.S. stopped financing, the whole thing would wind down in a hurry in both places.